gold and silver are under pressure from the same thing as all markets. And of course, we're talking about interest rates, the Federal Reserve, and what's coming in the next 6 weeks that could pretend a change is in the wind. Stay tuned. On April 30th and May 1st, the Federal Reserve met and discussed the state of the economy, inflation, and where to set interest rates, among other things. We also had the April jobs report on May 3rd, just after the Federal Reserve met. Heading into the Fed meeting, investors had already read the tea leaves and were feeling pessimistic about rate cuts. No one expected the Federal Reserve to cut rates on May 1st, and expectations were met. The Fed struck a hawkish tone, reiterated their commitment to achieving price stability, and indicated that further improvements to inflation would need to be seen before cutting rates. Looking ahead, we have a few key dates to keep an eye out for, and most of these center around rate cuts or help inform rate cut decisions at the Federal Reserve. Why? Lowering rates is good for gold and it's good for silver, and we'll give more detail on that later on. On May 15th, we'll have the April CPI report. Remember, the Fed's goal is to reach 2% inflation, and they want to see inflation trending downwards before they feel comfortable cutting rates. The Fed first made positive statements about cutting rates when we were over 3% inflation but trending downwards, and for months now, we've been stuck at around 3% on CPI and have had some choppiness in the data showing inflation trending back upwards. March's CPI report showed an increase by 0.4%. To have high hopes of rates dropping this year, we'll need to see positive news in the next few months in the CPI report or the PCE report. While the CPI report is an important indicator, the Fed does prefer this PCE report for inflation. PCE stands for Personal Consumption Expenditures. May 30th is the next event, which we expect to be relatively quiet. We should see the second estimate of first quarter GDP. While the advance estimate that was released on April 25th is an important indicator, it's not uncommon to see revisions to GDP in the second and third estimate. Any large changes could affect markets, especially if GDP is significantly lowered. That could be interpreted as a bullish sign for future rate cut possibilities. A Q1 2024's advance estimate put first quarter GDP at a low 1.6%. The very next day is the release of the April PCE report. When the Fed says they're targeting 2% inflation, they're probably referring to this one, which is generally lower than the CPI report. The last report to come in was at 2.8%, and we've seen inflation reduction stall within this report as well. May 31st could be a big day. Because investors know the Fed is looking at this report closely, then an improvement in the numbers will boost investor confidence in seeing rate cuts this year. If it's flat or it goes up, it could be a bad day for markets, including gold and silver. Then it's June 7th for the May jobs report, which is the one the Fed will probably reference in its upcoming meeting on June 11th. Although the Fed has a dual mandate of maintaining maximum employment and achieving price stability, the two are often at odds with each other. Historically, the Fed does not get inflation under control until they've caused a recession, doing exactly what they're doing now with monetary policy, which has not been good for jobs historically. The June meeting that starts on the 11th is an important one because it includes a summary of economic projections. On June 12th, we have two big events. The first is the release of that summary of economic projections along with comments from the Fed. This is when they update the dot plot, and it will give us a good idea on what the consensus is amongst board members for rate cuts leading into the second half of the year. The second event occurring on June 12th is a release of the May CPI report. It will be interesting to see how this factors into the Fed's meeting. The CPI report is due to be released at 8:30 a.m., and we normally don't hear from the Fed until the afternoon. If the May CPI report trends with the PCE report, which it often does, then there shouldn't be any surprises. Markets on June 12th could be particularly volatile, especially if the dot plot paints a picture that is either dire or celebratory. Remember that at one point as many as 6 rate cuts were being talked about this year amongst the general public. Now investors would be lucky to see 1 or 2 by year's end. We have noted in prior videos we thought 6 rate cuts was overly optimistic, and we're maintaining our wait and see approach here as well. Markets and pundits seem eager to find optimism or crisis in even the most measured remarks, But it's our view that the Federal Reserve statements have been consistent with their behavior thus far. We should not expect to see rate cuts until the Fed is confident that inflation has been beaten, and that will take some time. If it seems like everything is revolving around interest rates, that's because it kind of is. We reached the peak of the tightening cycle according to many, including the Federal Reserve. Gold and silver are at the mercy of interest rates for a couple of big reasons. First, gold's main competitor as a safe haven asset includes treasuries. Treasuries have a yield, which gold doesn't have. So when rates are really high, it makes the alternative safe haven asset more desirable. In addition, there's a strong correlation between gold and real interest rates, of which inflation and interest rates are a component. If real interest rates turn negative, gold traditionally performs extremely well. So investors are looking at interest rates when considering gold. Silver is a bit more interesting. It has many applications for both investors and for industries. The industrial use of silver consumes most silver demand in any given year, and industry tends to do better and make more investments and produce more goods and services that require the use of silver when rates are lower, especially capital-intensive industries like solar or automotive. As rates decline, demand spurs and capital markets open up with cheaper liquidity. Overall, things just tend to boom a bit more when rates are lower, and that is historically good for silver. So, keep an eye on the dates we've talked about today. May 15th with the April CPI report, May 30th with the second estimate of first quarter GDP for 2024, May 31st for the Fed's favorite inflation metric, the PCE report, June 7th for the May jobs report, and finally, the one with the most disruptive potential, June 12th, which includes both the CPI report and the Fed meeting with news about 2024 rate cuts. That's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.